Welcome to your daily dose of dividend. Today we're going to do a portfolio update for May. And just brief, my investing strategy is I invest 10% of my monthly income, no more no less. And I aim for 50% index funds and the rest in dividend stocks. And I try to not make any impulse purchases because as in point 3, if it's a good company, it will still be there next week/month. And try to invest in strong brands and no unprofitable companies. And then we just sit back and let the dividend start rolling in. So if we take a look at the current holdings, it's been quite a harsh month. The portfolio has gone down about $200. And first of all, the best stock so far is Johnson & Johnson. And healthcare is resisting the recession a bit. So I'm very pleased to have Johnson & Johnson in the portfolio, even if they're not the strongest growth stocks out there. Then Realty Income is also doing fairly well. Comcast is also holding up quite well. We can see here for Merck, it actually has had a negative month, but it's probably it seems to be about break-even for me at least. 3M has also gone down a bit. It was actually, maybe up 5-6% before this month. And JPM is doing okay. And Home Depot has turned down again. And then it's just a red for UPS and HB. TSM is doing fairly well, but in the last of month, they are turning down also. The Swedish investment firm Investor is like a Swedish Berkshire Hathaway. They are holding up okay, but Stanley Black & Decker has is quite a negative return. Also for Starbucks, but they were already quite a negative return, and they held up quite okay last month at least. T. Rowe also down a bit, and worst for me is SBB. It's a Swedish real estate company that's actually doing terrible. It's free falling right now, so that's the one I had the least return in. We can see that the total value is about 19k, and Friday wasn't a good day for me. Negative almost 4%. I think maybe the Dow Jones/Nasdaq was down 3%. And the total return is now negative 6%. But the dividend goes up a bit when the stock prices go down. So the overall dividend for the portfolio is now 3.3%, which is quite good. And the annual dividend, expected dividend, is $631. As I said, I'm aiming for 50% index funds and ETFs. So here are my ETFs. I have a global ETF that I have 70% of my ETFs in. And I have 15% in emerging markets and 15% in Swedish index funds. And that makes up $19,296. So that is almost exactly the same as the dividend portfolio. If we go to the data tab, we can see that the numbers for May are a total of 40,157. So it's been about the same since February. And I guess in February were also when the stock market started to go down quite a lot. And the dividend for May was $45.56 with $28 from Investor, $7 from Realty Income, and $10 from Starbucks. If we take a look at the graphs, we can see that the portfolio has stagnated a bit, but overall it's no big deal really. The dividends are also okay. In the beginning, I invested in some companies that paid a bit more dividend, but now I have focused a bit more on quality and dividend growth. And to the bottom left, we can see the sector allocation of the dividend portfolio. And I think it looks quite good. A bit heavy in consumer, but that's both consumer staples and consumer discretionary. So that looks fine overall. And on the right, we can see that here are the individual holdings for the portfolio. And one stock that I got rid of this month was Pepsi. And one can say Pepsi might be a good stock to hold right now when the inflation is quite high and there's a bit more spending on maybe the staples, but it has had an insane valuation, so I sold it. The next tab is my watch list, but I think we will save that maybe for a different video. We can now take a look at the current valuations of the individual holdings in the portfolio in fast graphs. And we can actually begin with Pepsi so we can see why I sold off in that position. I usually put the graph into a 13-year price history, because then we have 10 years of history and 3 years of future estimates. And here we can see that Pepsi actually had quite a high valuation. And 1.5 year forward, it would actually make a negative total annual rate of return. So I sold it here at about $165. If we now take a look at the holdings, the first one is Comcast. And one would think Comcast would get slaughtered with the streaming services from like Netflix, HBO, and so on. But they have a very consistent earnings growth. The earnings growth is the orange line, and the blue line is the average PE that the stock has traded at. So I added quite recently in Comcast because I believed it was a bit undervalued, and also it's growing quite fast. So if we take a look forward, we can actually see that Comcast might have a splendid time ahead of them. Next one is Home Depot. And Home Depot is also really, really nice earnings growth. Also very, very consistent. But they're trading down quite a lot. And historically, we can see that it might be a good opportunity to add some Home Depot right now. And it's also a very nice quality company. In my fundamental flashcard analysis, it got 10 out of 10 points. Then we have HBQ, and HBQ is trading at a PE of 8.6. Buffett added some HBQ. I can't remember if it was, I think it was over here, maybe, some months ago. And I think also it's a bit undervalued. I don't think it can drop that much more and should be quite safe bet with some nice upside. Then we have J&J. And J&J, I mean, with its AAA credit rating, I think it's only Microsoft and J&J that has that. It's just a very, very stable, consistent stock holding. But overall, it's not growing very fast. So if you're in your early years of investing, you might want to evaluate to have J&J in your portfolio, because on average, we can, for example, see here, if we go for the S&P 500, it should have a 9.5. For 10 years, it has about 9 to 10% annual earnings growth. So you might be better off with another holding. So I'm not exactly sure. I'm in my 40s, so I realistically have about 20 years left of investing if I'm gonna keep my J&J in my portfolio. I have some other healthcare stocks that I'm interested in, so if they come down in price, I will probably swap. Then we have my JPM, and JPM is also trading quite low compared to its historical prices. So if it's gonna go back to its mean and what the analysts think, we might have a quite nice annual return rate. Then we have 3M, and this is also a slow growing company with some litigation issues, and yeah, this is probably a bit of a shorter play for me valuation wise, and they have a nice dividend, and I believe if this stock comes up to its normal valuation, I will probably exit out of this position. So this might be a bit shorter investment for me at least. Then we have Merck. Same here for Merck. It's quite actually consistent in its earnings growth. And yeah, 7% earnings growth is a bit mediocre, but not terrible. And they seem to be a bit undervalued. Then we have realty income, and then we have to swap to AFFO here in fast graphs, so we get a better picture. And realty income is growing at about 6%, so they have also slowed down a bit, but REITs are a bit special, so you can't evaluate them the same as ordinary stocks. But I think anyway the valuation seems actually reasonable. It's valued about somewhere at the disease drop. So yeah, it should probably do fine in the next coming of years, and it's a very, very safe dividend and a high dividend of 4.5%. Next up is Starbucks, and we're gonna swap back to earnings growth. And Starbucks has also actually a very consistent earnings growth if you take out the disease period. And right now you can probably get it at a nice discount. And if the analysis are right, up to late 2024, you might look at a total annual rate of return of 24%. Next one is Stanley Black & Decker. And this is to put some industrial in the portfolio. And here you can see also the valuation actually has dropped quite a lot. So yeah, here is also might be a nice opportunity if it's gonna return to its mean valuation. You might look at the 30 plus total annual rate of return. Then we have T. Rowe Price Group. It's also a 10 out of 10 in my fundamental fact sheet flashcard, and they have incredibly strong dividend record, and yeah, they are also dropping a lot, so this might be a good time to pick them up if you believe in the company long term. Then you might have a 20 plus total annual rate of return to late 2024. And we need some tech in the portfolio also, and here I really like TSM, the best, at least in my sight, the semiconductor company. They are just trucking along really, really nice, and got explosive growth, of course, in the chip shortage period, and are expected to grow really a lot. And the total annual growth rate of the earnings is a massive 18%. And if they keep growing at this pace, which might be a bit hard for them, but if they keep up, you're looking at the 19% total annual rate of return. And last, we have UPS. And same here, UPS, very, very steady company. And right now, UPS has a total annual rate of return of 20%. So that was it for the portfolio update, guys. If you like a copy of the portfolio, the portfolio tracker sheet, you can get it in the description of the video. You just need to fill in the light blue fields. The rest the sheet does itself. So yeah, that's it for this time. See you next time, guys. Bye.